Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, June 16, 2015, and you're looking at a daily chart of the E-mini or the ES September contract. And what we have here is another, at least for today, seemingly successful test of the most recent lows. So I'm going to go to a 60-minute chart, and we're going to talk about this for a second. Early this morning, and this was down at 4 o'clock in the morning, the futures scaled down and actually pierced through the prior low and then reversed higher throughout the day. And they reversed higher even before the market opened, so the opening was relatively flat. And the reason I wanted to bring this up is because I'm going to flip over to the spider, but we're going to come back to the ES for a second. You'll see that today the low on the spider contract was, or the spider ETF, was 208.72, nowhere near the 208 level from yesterday down here. And I want to go back to the ES. I want to talk about that for a minute. So the futures found it necessary to go back and retest the low, and what was interesting was we pierced it by just a fraction, 1 point. This low was 2062.75, and this low was 2062. So less than 1 point, we pierced the low and then reversed higher, and that's not that abnormal. In fact, that's completely normal because typically folks put a stop on a certain number or slightly below the number, like a quarter of a point below the number. And when the institutions in light volumes, specifically pre-market or aftermarket in the Globex session, they can take the ES contract pretty much anywhere they want. So they'll typically stop you out and then rip it higher. That's why we don't put hard stops in, at least if we're sitting in front of the computer, because that's exactly what happens. So I thought it was interesting. We had a successful retest on the ES, but not a retest on the SPY. So as a result, I want to go over to the SPY. So as a result, I actually recalculated the all the numbers, okay? And we have slightly different numbers. They're not that much different, but they are slightly different. So we'll go through the numbers on the SPY first. First, let's talk about what happened. So the other day, we had a rip higher, and then what we thought might happen was a pullback to either here or here, okay? One of these three or maybe even four price levels here. We jumped over this one, and we started consolidating around this price level, which is 210.45. It was slightly different then. And then we finally settled on this one at 209.94. Again, slightly different by just pennies, but slightly different the other day. And then the following day we gapped down again, and we had a retest of the low here, and then now we're moving higher again. What's interesting is, where do we go from here? Well, we have the Fed that began meeting today, and probably today they didn't do much. But tomorrow they're going to come out with an announcement. There's going to be a press conference held by Janet Yellen, the chair of the Federal Open Market Committee, and you're going to hear some rhetoric. You're going to hear analysis by the talking heads in the media. All of it is nonsense, but yet the market will whip around tomorrow at around, I think it's 2:15 or 2:30, 2:15, something like that. Either way, the market will whip around, and then it'll pick a direction and go. Well, what direction is that going to be? Normally, the first move is the wrong move at this stage of the game, and I think it's worth mentioning now that today marked a short-term cycle bottom in the market, okay? Right here. All right, well, actually, it was right here. Whether that holds into tomorrow or not remains to be seen. It's nothing you can trade off of now. I'm just saying short-term cycles, and these are daily cycles. So it could be a 30-day cycle, a 40-day cycle, could be shorter, could be a 21-day cycle, could be any number of things. I'm not going to give the whole ball of wax here and what it actually is, but what I will tell you is sometimes they hold for a day, and sometimes they hold for several days, or sometimes they roll into a weekly bottom. We'll see what happens. I'm not suggesting that is happening here yet. We don't have enough evidence to say that yet. But what I can tell you is, let's look at how the market reacted off these price levels, okay? So here we consolidated right above the 208.87. We marched higher. We really blew through this 209.43, and you can pretty much make a case we blew through the next one too, but we're consolidating below the 210.45. And what that tells me is that the market wants to make a run higher, but there's always a but. But you may have some weakness tomorrow. Why? Because normally there'll be some nervous discussions around the Federal Reserve meeting, which is tomorrow. So early in the day, you're going to get a lot of rumors. You can get a few sell-offs of 5 or 10 points in the S&P. That's not out of the ordinary. You're still susceptible to the Greece news. You're still going to get a rumor or two with Greece. And by the way, it's beyond me how the media could report on a rumor. Isn't that spectacular? Think about that. It's an oxymoron at its finest. How do you report on a rumor? Reporting is supposed to be journalism, but that's not what they do. They report on rumors. It's fascinating. Anyway, so all in all, as long as we're going to march higher, and I believe we are, here are your there's really three next important price levels. You're going to have a gap window here, which is going to put the market at the spider at 210.83, 210.84. We'll call it 210.85. Then you have a 211, which is an even number, so you're susceptible to have that as a magnet on the way up. And this is also the 200 period moving average on the hourly chart right above it. And then you're going to have a gap fill that's going to be right here at about 211.60. So, and then you have double top from the other day. So there's a lot of resistance here, but what's going to happen is whichever the direction is after the Fed meeting is most likely going to carry the market for the next few days. Okay, so if it's higher, then most likely you're going to go at least to double top here. If it's lower, you're going to go down to double bottom, and the chances are that it's not going to hold. Okay, so if we're going down after the Fed meeting, for example, okay, you need to be careful because there's a high probability that if you go lower again, right back down to the 208 area one more time for the third time in a few days, there's a high probability in my work that it's not going to hold. And if it doesn't hold, you're probably looking at 60, 50 or 60 S&P handles on the downside, okay? So be careful. But that's the best I can do, which is giving you the upside and the downside. I would be a fool to say I know what's going to happen after the Fed meeting. It's not fair. I can't do that to you because nobody really knows. Nobody knows what they're going to say. Nobody knows how the market's going to react. Nobody knows how the market's going to react on some kind of Greece nonsense tomorrow. So this is a time when you shouldn't have a lot of exposure around these type of events, especially during options expiration week, which exacerbates the issue. It exacerbates the moves because the institutions are able to take the market in one direction or another at will. And with all those things converging, options X, the Greece, the Federal Reserve, there's really no way to say, I know what's going to happen tomorrow. That's a fool's game. I can't do that to you. It's not fair to you. It's not fair to me. It's not fair to anybody. So what I can do is give you price levels that are relevant, which I've given you here, and we look for support and resistance levels as the market's moving into those price levels, either upside or the downside. Now let's look at the ES, and these numbers are holding a little more true to form. Now, both numbers were recalculated on the SPY and the ES, but look at these numbers here. When you look at this and you say, okay, so first you came into this price level here at 2070, I'm sorry, what was this? 2073, okay? Yeah, 2073, you beat it here, beat up against it here, pierced through it, and then rocketed higher. Then you stalled out right at the 2079, pierced through it, failed, came back down almost all the way to the next price level, recovered, went higher, okay? Went through the next price level at 2084, went to 2085. That number seems to interchange 2085, 2084. Then you came back to retest it and went higher. Where'd you go? right to the next price level, 2090. And by the way, folks, I didn't draw these in after the fact. These are the new calculations, and they're holding true for now. So the next level is 2095, 2095 and a half is really the number. And you can see all the resistance up in this area, or this was support. Now it will be resistance. You see all these times the market beat on that number. Okay, that's going to be formidable resistance unless, for some reason, the market just blows right through it, and that could happen tomorrow. We've seen weirder things happen around Fed announcements, right? So these price levels are working. So for tomorrow, the best you can do is write down these price levels, understand them, and the next one after 2095 is really 2100. I'll draw it in here. It's a pretty obvious round number. 2100 would be a natural stopping point, okay? And then you have double top. Remember the 2105, how important that was? Well, it's now really 2107, but it's the same routine. It's as important as it is before, or as it was before. It's in there. You just can't see it. Okay, so that's the story in the S&P. Hopefully that's helpful. You have the price levels. Just trade accordingly, knowing what's going on this week. Be very careful. Let's go over to oil. I'll get to gold in a second. So oil, this is 60-minute chart. Oil is interesting because it's fooling with this 59.75. And if I bring in the 10-minute chart, you can see the importance of that. We came through it today, but spiked right back over it. This was at around midday here, and never visited that line again. Tried a couple times, but never visited that line. So as long as we remain above 59.75, I'm bullish this market. Let's take a longer term view for a second. Okay, so here, let's go one step further. As long as you stay above 59, well, that's the same number, 59.80, 59.75. We're trying to work our way higher. Let's look at a daily chart, and let me show you what I'm looking at here from a longer term perspective. When you take a look at the daily chart, you kind of clear up the nonsense with the back and forth of the 10-minute and the hourly charts, and you say, all right, so where's this thing going day by day? And what you have here is you basically have a long sideways consolidation effort in the gold, in the oil market. So you're up, you're down, you're up, you're down, you're up, you're down, you're up, you came down. We'll see, this time you only came down about halfway to the last move, which is about a 50% retracement. You're above an important number of 59.75, and as long as you can stay above that, 61.75 should act as a magnet, and if you can get above that, then you go to double top up here. This is a bullish pattern, folks. There's really nothing bearish about oil right now. The only thing holding oil back is really, right now, seeing what the Fed is going to do. Now, I know it sounds strange, and I know markets trade independently of each other and all that stuff, but nevertheless, the traders out there, the investors out there, the market participants don't believe that. They're the herd mentality, and they believe that the Fed is going to say something and the market's going to, and it is going to react, but it's not dependent on. But nevertheless, I'm okay with that because I know what I'm looking for. I'm looking for the market to stay above 59.75, and I think there's higher prices to come. Now, if I zoom out even further, look what I'm looking at here. So forget the 59.75 on a weekly and look at the 58.70. Okay, you can see the 58.70 is really a bigger line in the sand on a longer term basis. So I want weekly closes above 58.70, 59.75 on a weekly would be wonderful. But I want weekly closes above 58.70, and this is a bullish pattern. This has been going sideways for 1, 2, 3, 4, 5, 6, 7, 8 weeks. Okay, remember what I say. Anywhere between 6 to 10 candles. It could be a 10-minute chart. It could be an hourly chart, a daily, a weekly, a monthly. But when you have that scenario like in here, when you've got 6 to 10 consecutive weeks doing the same thing, what the market is doing is It's essentially consolidating to make a move. And normally, after an up move and you consolidate, you're waiting or you're getting ready for another up move higher. Okay, so it's kind of like the ABC, only it's more of a sideways consolidation. A, B, C. And that's what seems to be developing, at least in my work, on the weekly chart. So I'm bullish oil for higher prices based on my work, my calculations, and all the common sense stuff that I just told you about. I'm bullish oil. Let's go to gold. Okay, gold is struggling a little bit, but it's encouraging that, I'm going to go to the hourly first. It's encouraging that we keep trying to sell off, and we made another higher low based on this here. So what we did was, and remember, this red line, and this is a red line, 1174, you close below that and you begin to close below that hourly and beyond. Okay, and I'm not talking about just a spike. I'm talking about, an hour, another hour, daily closes. Then you're in trouble. But that's not what happened here. And once this market recovered 1174, it shot higher. You came back down and came up short of the 1174, which tells me there's a bullish undertow to the market. Okay, and then what you have here is you have a reversal. And by the way, this was on volume. That's important. It's on volume, which means you can look at this down move, this big extensive candle on volume. You can call that an exhaustive move, okay? And that's usually the end of a move, okay? A large move on volume is generally the end of a move. What did you have here? Okay, you had this candle here, this big up candle here was on volume here. Okay, you see this volume candle? Same thing. This was the end of the move. This was the end of the move. On volume, on volume. So you had a reversal, and now you're doing the same thing on a micro basis. This is an hourly chart as opposed to oil, which was a weekly chart, but it's the same thing. 1, 2, 3, 4, 5, 6, 7. In between 6 to 7 candles on the hourly chart, you had an up move off this low. You moved sideways now for 6 to 10 candles and getting ready for another up move. Not to say the market can't come back and test some of these lower levels, 1180, 1175. There's no question it can test those levels. But in my book, okay, we're setting up to get through this high here. This was a big exhaustive candle on volume. In order to get above this high and above this candle setting up for higher prices, at least achieve the next target at 1175. And I know I'm talking on a micro level, I get that, but this stuff applies in any time frame. So as long as you're setting up, the more you consolidate underneath this 50 period moving average, okay, underneath and close to the high of this candle here, which was a big exhaustive move, the more likely you are building up momentum or getting ready to build momentum to push through it. That's the way I look at it. I've seen it before thousands of times. That's what I'm looking for, okay? Here's a move, 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 or 10 sideways moves after a down move, and you moved lower. It's just another example. Sometimes those patterns fail, sometimes they don't. Up move, 1, 2, 3, 4, 5, 6, 7, 8, 9. Up move, okay? It just, it doesn't all have to look the same, but when you start seeing them, okay, here's a failure. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, you failed. Now, not all the time will you fail and not all the time will you succeed, but what happens is when you fail, you generally will go down in the same proportion you would have went up. And how much would you have went up from here? Well, I've showed you before how to calculate it, and I'm going to show you real quick again. you take the low and the high of the big up candle here, okay, and then you take a low from this consolidation pattern, and then you can flip it and say that distance from low to high would be the same from low to high. So if that's the case, so using real numbers, the high was 1190, the low was 1180 and change. We'll just call it $10 for argument's sake. So what you would have had here from low, 1183, you only would have been up to 1193 on the high, but instead you went lower from 1193. Where'd you go? 1183. Where'd you go? 1175. Pretty close to 1173. You see how that market symmetry works? So you basically went down almost within $1 or $2, almost the same distance that you would have went up. That's just the way it works. It's pretty fascinating, isn't it? Okay, so just to take a gander at the longer term picture of gold, just so we have it, you know, nothing's really different. We just need to bust through the highs over here, really this high here, in order to see significantly higher prices. Now, what do I think longer term? Same thing holds true. I believe, based on my work, based on the calculations, the cyclicality, where I think gold is going, I think within the next, let's just say 4 to 6 weeks, give or take, I think we're going to find gold significantly higher than we are now. It's going to catch most people by surprise because you're going to wake up one day and it's going to be up $20 or $30. Or it's going to shoot up $20 or $30 based on some Fed announcement, based on something out of Europe, based on something that is an exogenous event or a surprise or something. That's the way it works. It's most likely not going to grind higher $2 to $5 a day for 5 weeks. It just doesn't work like that, right? So what I think is going to happen here is I think we're going to get a pop. However, be aware the downside is in play, and at 1174, a break of 1174 brings 1155 into play. Just be aware of it. Know your numbers, okay? Let's go to the bond market. TLT, a little bit higher. Pretty good up day, up $1 in TLT. Now, I thought we might even pull back a little bit more and see maybe a 50% or more pullback from this up move here, but that didn't happen. It was just a minor pullback yesterday, and we continue to march higher today. And as long as we stay above this 11, hold on a second, the 118.21. Bear with me 1 second, folks. Okay, that was the number that I put in yesterday as the possible pullback, or was it? I believe so. No. That was the previous low. I apologize. That was that line that's been here a long time. The low from before. Actually, we don't need that now. We're above it, and that's not relevant anymore. And I guess yesterday and the day before, you could say that was trying to act as some level of resistance. Prior support is current resistance. But we got through it almost into the 20-period moving average. But all is good. Like I've been saying, you can trail a stop if you're long from this level, or you can wait for a pullback to get in. But nevertheless, this was a spectacular trade. I know some folks are still in it. I think there's higher prices coming in the bond market. This was a very, very good low, long-term low. Very good number. We had that one spot on. So not much else to talk about in the bond market. There's just nothing else to say except it looks like, based on an hourly chart, it looks like it probably wants to get into the 200-period moving average, probably get up into this gap window at 120. It's just that simple. 120, 120 and a quarter. You'll find some type of resistance there. If you get a spike, and that's certainly possible tomorrow, you'll go up to 121, and those are your numbers. We can even put those in. 121, I think that was 120.105, and this would be, let's see, this would be the open of the day was 120.17, and I get the open, for those of you that don't know how to do that, 120.17. For those of you that don't know what I just did, what I did was I took the opening price of this level here, okay, which is a open gap from the prior day or the prior hour. And that's going to act as some resistance up here during the day, okay? So, and it's actually the high is the correct number. I apologize. It's 26 is where this should be because the high is the gap window, okay? There you go. All right. So not much to talk else about on bonds. We're off these lows, probably higher prices to come, yields coming down a little bit, and that's what we have in bonds. What else do we have? Let's talk about SodaStream for a second. We'll get to the dollar in a second, but there's nothing going on there. SodaStream is in good shape, and I want to give you a price target because I'm going to sell it at some point. If you're in this one, you know it's in the portfolio, you know we've had it for a while, and we're up about 15%, and I've got a target in mind. And my target is basically, I'm going to show you the market symmetry and how I calculate the price target again, not necessarily using the mathematical calculations, that's something different, but showing you the symmetrical calculation. And even though it sounds kind of strange, and it even looks strange when I explain it to some people, it works over and over again. So watch this, okay? You have a low here at 118.15 against a high here, okay, when you started to consolidate at 22.61. So 22.61 from, or 18.15 from 22.61 is about $4.50. We're going to call it $4.50. We're rounding a few pennies. That's fine. Okay, so what I do is I take the low point of the consolidation, which is here, okay, and that number was 20.50, okay. 20.50 I'm going to add to $4.50. Gives you a round number 25. It's that simple. It's not an exact science, but once we get close to 25, I'm going to tighten my stop and I'm going to let the market take me out. And if we get more out of it, that's fine, but I'm not going to let that profit go away because it'll be most likely, I guess, at that time it'll be over a 20% profit, and I want it, right? So here's where we're looking. If I go to a weekly chart, all right, I'm looking in this neighborhood here. And you can see you're going to start coming into this pivot high. This is going to be formidable resistance, this big red candle here. Now that high is way higher at 28.88, but that was on big volume. So you'd have to have similar or greater volume in order to get through that level. I'm not even looking at that. It may happen, it may not happen. I don't know, but I'm telling you my target on this trade, and that's where we are. So in case you're interested, that's where we are on soda. Let's go over to the dollar for a second, and let's see, we got the September U contract. Let's go to the daily. Nothing going on, but you've got to expect movement on the dollar tomorrow around the Fed. Movement on the dollar, movement on Europe, movement in gold, movement in oil, and the bond market, and the stock market. We generally see all those assets move in and around the Fed announcement. So what do I have to say about the dollar? Well, I could say two things about the dollar. It's very interesting. I could say that from this low to this high, we've basically retraced about 6.618% of the retracement, and maybe the market goes higher. I could also say the market made a down move and we're consolidating sideways for another down move. You see, it's inconclusive. So I'm not sure exactly what's going to play out, and we just have to wait for the market to tell us what to do. In and around the Fed meeting with conflicting patterns, I don't have a trade in the dollar. I have to wait for more information, wait for more pieces to the puzzle to put together before doing anything. I know this video is long-winded. I apologize. We're going to end it here. Hopefully it's helpful. I'm David Frost, mystrategicforecast.com. Thanks for tuning in, folks. Another episode of Common Sense Market Analysis.